Break even is a number that you would have seen a lot talked about on other content we have on our website. In summary, the reason it is so important is we need to understand it as a business, what we need to do as a minimum to survive. Now, if you've done accounting degrees or a CPA or a CA or something of that accord, you're most likely to have learned a break even from a profit and loss perspective. So when you backtrack the break even, you'll end up with zero at the profit or loss line. We like to take that one step further and call it an equity break even. The reason why this is so important is because we're in business not just to break even, we want to make sure we at the very least protect our equity position we have in the business. The calculation for break even to begin with at a profit and loss level is your contribution margin divided by your fixed cost of goods sold plus your overheads equals your P&L break even. The reason we don't want it to just profit and loss break even is because there's two other elements that are included on our financial reporting that impact equity, but you don't see on your profit and loss. The first of those elements are our loan repayments. That could be for equipment finance, it could be for a business loan. We need to factor in those loan repayments. The second part is a lot of owners don't take wages in the traditional form and they don't show on your profit and loss. So if you're taking drawings out of your business further to your wages, they need to be factored into your equity break even as well. All of a sudden, the calculation becomes contribution margin divided by fixed cost of goods sold plus overheads plus loan repayments plus owner's drawings. That there gives us our equity break even. And if you really want to challenge yourself, I would also include a residual profits target. If you want to share a break-even number with your team, you have to include a number which factors in your equity growth within your business at an absolute minimum, setting a minimum target of what you want to grow your equity by. You don't want people walking out at the end of the month going, we at least broke even. We want them walking out at the end of the month going, okay, we've achieved that number, and that number for you personally builds some equity within your business. Therefore, the calculation becomes contribution margin divided by fixed cost of goods sold plus overhead plus loan repayments plus owner's drawings plus residual profits target. And I'm at pains to say that residual profits target is a bare minimum target. It's not ultimately where you want to be, but it's the minimum number you need to achieve to satisfy yourself that the business is going in the right direction. How do we influence this number? Well, ultimately it's optimizing our contribution margin. The higher that number, the lower our break even will be, relatively speaking. And then you want to reduce your costs at your fixed cost of goods sold, your overheads, your loan repayments, your drawings, and also your residual profits target. But is that practical? Not really, because some of the things I've just asked to reduce are things we don't really want to reduce, like the return you get as an absolute minimum within your business and also your drawings. Therefore, I believe the most important way to improve what you have on the bottom line, demand more from your people in a structured way, and I don't mean cracking the whip. Build a work environment that you can optimize your return on all your investments you make within your business. There's quick gains that can be achieved if you're in a challenging situation by reducing those costs. That's completely understandable. But if you're in a business as usual situation, you really want to optimize your return on your investments, not depress the cost of them.